Hello, and welcome to the presentation from the Imperial College Business School team of Dr. Yami Chong, Faisal Fatil, Cormac Goulding, and Dr. Sarah Moradi. Our proposal is called the Convertible Emissions Performance Bond. In the CEP bond, we're proposing to adapt the convertible bond concept to incentivize reductions in greenhouse gas emissions. The IPCC estimate that to transition to a low carbon economy, we need to invest between $1.6 and $3.8 trillion annually until 2050 for supply-side energy systems alone. However, the existing solutions have weaknesses and are not generating the necessary level of investment. For example, carbon taxes increase the cost of emitting greenhouse gases, but do not place an upper bound on emissions. Cap and trade schemes, such as the EU's emissions trading scheme, are undermined by exemptions and subsidies and do not guarantee that the revenue funds climate mitigation. Climate and green bonds have been criticised with respect to their sustainability credentials and the monitoring and reporting of their impacts. The UN estimate that we need to reduce emissions globally by over 7% per annum until 2030. Shrinking the economy is not an option. The cost per unit GDP of carbon emissions reduction due to the COVID-19 pandemic is an order of magnitude greater than the reductions that can be achieved through investment. Companies need access to low-cost finance to bridge the investment gap. Our aim is to bridge this gap by offering a credible alternative, attractive to issuers and investors. The CEP bond provides an example of impact investing that not only benefits the stakeholders, but contributes to solutions to the problem. It uses a clear, measurable standard, the emissions of greenhouse gases, to ensure that the funds raised using the bond are having a real and measurable impact. This provides greater transparency and is compatible with digital solutions. By reducing emissions, companies show investors that they are transitioning to a low carbon future. Investors benefit from the conversion of bonds to equity when emissions targets are met, but also from the higher company valuation associated with good governance and risk management. This also reduces the cost of future financing for the issuer. The CEP bond adapts an existing mechanism that can be applied to all publicly listed companies, making it inherently feasible and scalable. By linking it to a single output, greenhouse gas emissions, it incentivizes the transition to a low carbon economy, and its impacts can be clearly defined.
So now we would like to illustrate how the CEP bond works. The CEP bond is a fixed term bond with options to be converted to common stocks at maturity. What makes this unique is that the conversion trigger is a specific, predefined greenhouse gas target. This aligns its structure with ESG guidelines and appeals to both ESG and non-ESG investors. The convertible option allows investors to enjoy equity-like returns when targets are met at maturity and the conversion is exercised. The CEP bond is an ideal financing product in the current low-yield economic environment, as issuers get access to cheap financing. According to Bloomberg, companies can issue convertible bonds at the rate of 1 to 2% cheaper than conventional bonds. As for investors, the structure reduces investment risk and could generate on average double the returns compared to conventional bonds. For example, Royal Dutch Shell is an ideal company to utilize this bond. Why? First, it is diversifying away from carbon sources. Second, it has clear green commitment that is to be a net zero emissions energy businesses by 2050. And third, it has pledged up to $3 billion of investments in sustainable projects annually. So instead of issuing green bonds to finance these projects, it could access cheaper financing from CEP bond, which links directly to its commitment. So to conclude, we believe the CEP bond proposal provides a robust framework for future climate financing program to unlock the investments and innovations in emissions reducing infrastructure that we need to save our planet. There are 4 compelling reasons why we believe this is the case. First, in terms of innovation, it adapts the well-known convertible bond structure to a new solution. Second, in terms of feasibility, the issuers benefit from reduced cost of capital, while investors earn both capital protection and enhanced returns. Third, the structure is highly scalable to meet different regulatory, environmental, and financial needs. It also complements existing solutions and overcomes some of their weaknesses. And finally, the climate impact is tangible given direct link to the emissions target. Thank you, and we're happy to receive your questions.